All right, guys. Today is Thursday, September 14th, 2023. I've got the Micro E-mini up at the moment, and what we're looking at right now is a 1 hour chart for the S&P 500, okay, the micros. Now, I did this yesterday, and I want to talk about what's really what we're seeing here as far as my boxes that I've drawn on, and also what this means, high time frame and lower time frame. You'll see I've written that a lot all over the screen. And I want to talk about this and why it has a W in there and what these boxes down here mean. Yeah, so let's get into it. So this first off, I'm just going to go to the daily chart. So what is it that's going on with these two massive boxes? Why have I drawn them? What do they represent? What does the W mean? And how does it all correlate, right, to the chart? So first thing I do, I look at S&P 500. This was yesterday. I haven't looked at the S&P 500 for a while. I pretty much called though. I remember back in 22 when I saw this break of structure over here. I said to my wife at the time, the S&P has shifted structures. Actually, maybe it was this break of structure. But it took out a primary range, which was important because I noticed that once it took out the primary range, that we're likely to have a pullback. And so we've been experiencing this pullback from this kind of level all the way down to this point here in 22, right, 2022. And so what I was basically telling her is, look, this uptrend is sort of shifted structure. So it's as I came to the chart yesterday to have another sort of a relook, because I don't trade the S&P 500. I don't trade futures. I trade the foreign exchange EU market. And as I looked, I'm looking for primary ranges. Okay, like for example, this was a sell primary range right here. And then I look for a sell primary range that then turns into a buy primary range immediately after. Okay, and so that's exactly what we've got going on here. Now, if you've never heard of a primary range, in my terminology, is a range that goes over the top of another range that was created for liquidity. For example, this range here, from this low to this high, is a decent looking range that initiates and breaks structure. Okay, we can still see that break of structure, got this range, boom, broke structure. Okay, what that does is it stacks liquidity above the highs, because if people were trading up here, here, they typically, if they're long-term traders, they're going to put their stops above the high, most recent high. And, they might have thought, well, let's just put them above these highs too, just to protect it even more. And what happened with the market? Came up right above them, snagged their liquidity, and then continued to push down. So this range here that went over the top of another range and then broke down on itself and broke other structure is considered a primary range. They can be sell primaries like this gray one, or they can be buy primaries like this blue one. So let's look at the blue one that I'm thinking, right? So it starts here and it comes down to a point where it's taken liquidity. Where is it taking liquidity from? Range, another range, another range, and initiation, right? So all of these ranges have liquidity stacked beneath them. Okay? So this blue box here started from this high, comes all the way down, takes liquidity, and then breaks on itself, and then breaks other structure. Did it actually break the structure? Okay, it didn't break the structure just yet. So it's trying to, though. This is because it's higher time frame, it's definitely trying. We're likely to get a break of structure up here pretty soon. So that's what these block boxes represent. But when they're stacked like this, back to back, when you've got a sell primary here, and that turns immediately into a buy primary, right? When that happens, what we're having is a liquidated state occurs 3 times. And what I mean is the very first leg right here that I'm drawing and circling, this very first leg here has already taken liquidity. It started off taking liquidity from beneath this range. So it's in a liquidated state, right? The next state that it moves into is the second leg up here. And this is the second state that we're in, which is another liquidated state, right? Because of this ranged, initiated, and broke structure. Therefore, there was liquidity. Okay, here was that structural breakdown here. So again, leg one and now leg two are in liquefied states. So we've been liquidated, and then the third part of this is that we get it one more time. Another liquidated state. This time the biprimary is formed. And as you can see, based on these structural breaks here, I think this is the one I was sort of taking. This break of structure, there's liquidity beneath here, beneath this range, right? And so they've taken the liquidity. So that's what I'm looking for as far as what I call a setup range or primary ranges. Okay, so this is a sell primary, this is a buy primary, and when you put them together, you get a setup. In my eyes, okay, this is the language that I use. This is the lingo. Okay, so we've got sell primary into buy primary. Okay, so that's what they represent. So now, why the W? What does the W represent? It represents weekly, and all it means is that from a weekly time frame, I'm able to see the same pattern completely formed. So, for example, here where my mouse is, let's do it with the circle thing again, right? You can see I have taken out structure from beneath this range. Again, same thing here. This is in a liquidated state, and the same thing here. This is again in a liquidated state because this candle went below the low of the high, representing to me that that is a pause in price, and so I can use that as structure. That's what I take structure from. And so for me, that's a structural break. And so I can use that as structure. So that's why. Now, if we go up to the monthly chart, do you see how now it's all looking lost? You see how the low of this candle didn't break the low of this one. And so I can't use it as structure anymore, right? So now it just looks like a couple of boxes slapped together, but there's no way to interpret that data. And so that's why there's a W in it, because it represents that it can all be seen on a weekly time frame, and that's the highest time frame it can possibly be seen on. Now, I've been doing this for a while, and I can tell you right now that if we have a weekly setup range occur, and everything is valid, then I can absolutely, with quite decent amounts of assurance, feel confident that price is going up from here. This is a weekly setup range. This is a low. We got the caret tool out. Where is it? This guy right here. We've got a low. Okay, 100% confirmed low in my eyes. Now it gets better. Okay, so if we just jump back down to the hourly, here's the weekly range, the weekly setup range that we've spotted. And as you can see at the very bottom, they did the exact same ending. So the low was in a liquidated state, the high liquidated state because of this range, and back down into another liquidated state. We can find all these breaks of structure over here. So I've got them all drawn out. There's the first one. Here's the second one that was of importance. Okay, and so it ended in a 1 hour or more potentially same setup range. Now that is indicative of an endpoint of a higher time frame reversal, is what that is. That's indicative of a higher time frame reversal. And so as I'm looking at the S&P 500, and I see this happen, my bias for weekly, monthly, daily, everything is up. I do expect a break of structure. I do, because we've mitigated a higher time frame and a lower time frame sell primary. So let's talk about that real quick. Okay, so I've just lost my arrow. I think it's because I'm on a too high of a time frame. There it is. So there's my little arrow back. Now, what did I just say and what does it mean? I just said it has mitigated, and let's clean this up. We don't need all this. Now I've explained it. We don't need all that drawing. So what does it mean? I just said we have mitigated a higher time frame and a lower time frame by primary. I'm certain of it without even having to look. Okay, and you can see these HTF and LTF. I've written these all over the place up here, and we're going to get down and dirty into it in a moment, just to explain what they are. But this is the start of explaining what they are. So as these ranges end, like this one, the weekly, and this one right down here, the hourly one, the lower time frame one. What's happening is they're mitigating something. They're stopping at a certain point and then initiating prices. We don't know where they're going to stop. We never ever know where they're going to stop. We don't know where they're going to stop price. How can we possibly know? We do know though that it will happen from a primary range. It always happens from a primary range. In all instruments, anything that you're trading is always we're gonna mitigate a higher time frame and a lower time frame primary range. Okay, so with that said, if on the daily, this is the daily chart. Okay, so again, while these aren't the best ranges, because this black candle here broke below the low of the candle that made the new high here, it's basically this, right? It's a pullback before it sort of keeps going on. There's another one here where it broke the candle that made the high, and so that's what that is. And so these are mini ranges for me with liquidity stacks, right? So that's how it looks for me. Got a dollar sign right there. And so, since these have dollar signs and they've broken structure to the upside, when this came back over the top of them, this became a primary range. It took liquidity from ranges that were ranges that had halted in price, broke down below a low of a candle, right? So remember, I'm on a daily. So these on a 1 hour were going to look quite massive, but to us on the daily, they don't look too crazy. And the last piece to the puzzle here is the breaking structure. So let's see that. Wrong one. Let's go breaking structure at the top. Put it at the top. So now we can see which candles actually did break structure first. So it would be, well, will it be this one? It looks like, let's have a look here. So this is the interesting part. So on the daily chart, it's hard to see because this does look like it had a breaking structure just here, just a minute one. It does look like they just nibbled liquidity. So let's drop to a 12-hour time frame just so we can see things a little bit better. And yeah, sure enough, it did break. So on a 12-hour here, we can now start to see that here was a range, number one. That was a buy range because it came below the low of the candle that made the high. This candle right here made the high, and then the next candle went below it. So that's a pause in price. And that looks actually like the only one on this time frame, except for this one right here. Just notice this one as well. Right? And then we got to look how far deep do we go. And of course, it went below this one as well. Right? So we've got 1, 2, 3 ranges now on the 12-hour chart that ranged, initiated, and broke structure. Here was that structural break. And then within a little bit of time later, this primary range got put in. It came right down to the bottom, took the liquidity from below this candles, all these candles, and all this liquidity here. Took all the liquidity and then took off, right? So there's one of our ranges. So when I say higher time frame and lower time frame by primary, this is the highest time frame by primary that I can spot. Because remember, I started on a weekly and then came down to actually, I think we started on the daily, start coming down and trying to figure out exactly where these candles were that got broken, see how they didn't actually break the lows here. So this one is 12 hours, and you just keep stepping down until you can find where it makes sense on the time frame, right? So this is definitely the highest time frame by primary that I can spot. Now, let's ray this out. Let's ray it out to here. So it wasn't until this point here, this candle here that broke up. What happened? It was just a spike candle, right? So it came up, took liquidity. They were just messing around. They were just doing a little liquidity grab before. And what happened was price broke through and came back down and then formed a new um, range right here, right? Now, we know it's a range because it took out the low of the candle that made the high, right? So as we were making these new highs, high, high, this one made the new high, then we had a pause in price because it came below the low. So this is a buy range right here. But I can already see that if we go down onto a lower time frame, we're going to be able to see that this little range here, the high here and the low here of this candle, ranged, initiated, they broke structure here with this candle and then came back over the top and just initiated away. That is a primary range. I can see it myself on this 12-hour chart. However, we're going to see it much better on a lower time frame. So let's do that. So here's the 1-hour chart. And now you can see quite clearly. Here's structure. Here's structure. Okay, so now let's look. Where did we stop? We stopped here. So this was one of the ranges. Where's another range? This potentially one of the ranges. It's kind of encompassed in here though, so we don't really need to draw it. Here's another range. See how it broke the low of the candle. Okay, and that's really it. You don't need to worry too much more about any of those. So what are these? These are liquidity. These are buy ranges that went buy, initiate, range, initiate, break a structure. Okay, which stacks money. Because and again, let's say why. Let's explain why it stacks money. Because when you break structure, if you're long, where do people put their stops? They move it, right? They're constantly moving their stops as price goes up, their stops getting moved. Not every trader trades the same way, but typically it's what we do. It's natural for us to want to move our stop and protect our positions. We don't want to give any more money back to the market. And so the market knows this. I say the market, it's the algorithm, it's the people who create the algorithm know this. And so they actually come back in to try to take their liquidity, even if we're initiating higher prices. So one of the things that I was taught a long time ago, this is from NJAT, is that if you start seeing things like this, equal lows or relatively equal lows or things like that, then they're going to run it. And that's not actually quite true. Yeah, they will run it out at some point, but it's really having market knowledge as to what's when they're going to run prices, why they're stacking. So we have got liquidity here, we have got liquidity here, we've got liquidity here, but as we know, ooh, that's funny. So my last search from Amazon. My wife wanted some organic bamboo toilet paper, so that's why that came up on a Control V. It was the last thing on my paste in my clipboard, I guess. But anyway, back to what I was saying. So these lows are stacked, right? They're stacked to get run, and yet they haven't been running freaking forever, right? If we go to the daily and have a look, they didn't get run for freaking forever more. You know what I mean? Or what it felt like that, and then they eventually get run down at this point down here, or potentially. So it's all relative. It's all relative to what you're doing. And let me try and get back to where we were. Nope. Sorry, you guys. Give me one sec. Messed that up a little bit. There we go. Okay, so 1 hour. So it's all relative. It's all relative. So really, what I wanted to mention that is because if you see equal lows, don't just suddenly start thinking, or relatively equal lows, don't suddenly start thinking they have to run it. I used to think like that. and it's not accurate. It stops you from getting in trades, is what that does. That will stop you from getting in trades. What you want to do is well, come up with your own things first, and discover and understand things for yourself. And then if you get to a place where you want to trade similar to me, what I would do is wait and see these kinds of setups where you understand high time frame and lower time frame mitigations. Okay, and so speaking of what we just have discovered, we've just learned that we've mitigated a higher time frame and a lower time frame by primary, haven't we? This was the higher time frame one. Here, let's make it big. And here's the lower time frame one. Now I knew they were going to be buy primaries because buy primaries support high prices. It's as simple as that. Buy primaries support higher prices. Sell primaries support lower prices. It's what the markets do. It's how we work. It's how they work. Okay? It's just a thing. So back to this weekly. Okay, so we got this weekly thing happened. We got this mitigation at the bottom. We had a higher time frame mitigation. We had a lower time frame mitigation, and I just explained them. This was the higher time frame bioprimary. This was the lower time frame bioprimary. So it was a 1 hour within what was a daily, I think, or a 12 hour. So pretty fascinating, pretty fun stuff. But now, how can we use that information, right? So don't forget, I've looked at the S&P 500 yesterday, put all these drawings on, and I'm explaining my drawings to you as to why I did what I did, and the reasons I go back this far back, looking at things from 2020. This isn't relevant, right? We might say, well, this isn't relevant to what's going on right up here, but absolutely it's relevant because I've got a freaking um, weekly setup that can absolutely break structure, should break structure. I'm shocked if it doesn't break structure at the top. So what's my bias? My high time frame bias is that we're just going to keep initiating up. So that means that every time that we break structure and have a pullback, I can look for re-entries going up. Okay? Every time we have a pullback, I can look for re-entries. Every break of structure is a new opportunity for us to get back into the market in a different way, in a different area. Now, we don't know exactly how they're going to do things, but what we do know is that um, we can get in and take some profit out of the markets. Now, I don't know, let's for example say if I entered here, right? Let's just for example say I entered here. I don't know for sure if this is going to work out, this trade. I don't know if it should even be like targeting the top here. Or because they can manipulate however they want. I don't know for sure, but I can definitely look at what have we mitigated, and if we've mitigated something that makes sense, then I can start looking for my trades in that direction. So, for instance, here's a good one. Haven't done this one before. This is like completely live, right? So here we are. Let's say we are. Wrong one. There. Let's say we are here in price, just for example, okay, and we've just got unlimited time. I know this is months and months and months. This is 12-hour chart, but let's say we're here in time. We've seen that the weekly's formed. We've seen that this is formed, and we're here-ish, and price is initiated and broken structure. Okay, so every time price comes back, right, and breaks basically breaks a breaker. All right, we'll talk about that. Breaks a breaker, that gives us an opportunity to look for longs. So what's a breaker, right? So here's a breaker, for instance. And let's make it as clear as we can. So here we go. We were here and we're initiating higher prices and higher prices and higher prices, and then they got down to here. And then all of a sudden they come up, break structure, and then slam through a range, right? That's a breaker. Or transitional order block, as I call them. Now we also had one here as well. So let's point that out. And we'll look at this one actually as well. We'll look at this one. So we had this range and then it comes over and breaks structure. So we had range initiation, break the structure, comes back in, takes it out, right? Goes through the breaker. And so as soon as that happens, we can then start monitoring for um, for mitigations, right? Monitoring for our mitigations, because we're now interested in looking at what have we mitigated, and how did it happen? So it mitigated here, right? And I can see it didn't actually break this candle, so we're going to look at that candle. So this is where we're going to do some investigating. And just by looking at time frames, I'm just going to skip to 1 hour, see what that looks like. Let's pull this out the way. Again, I have not done this. So this is completely unique and new to me as well. So what we're looking for is a high time frame and a low time frame mitigation. Okay, we've gotten, here's a range, an initiation. Let me just draw this on. Range, initiation, break a structure. Okay, so we've already got our first primary range, but did the primary break other structure? Let's see, did it break this one? Yep, that's a structure. So we can again say here the range activated at this point. Okay, so this biprimary is fully active at the moment it came above and broke structure here. Now, what happened was price came over the top of this range, right? Which they sometimes do. So they sometimes make a primary range and then come over the top of the primary range to create a new primary range, right? So think about it. Range, initiation, break a structure. Okay, I'm talking about this one. This one right here. Range, initiation, break a structure, stacks money. This is the range that came over the top to make it, and this is our higher time frame range. Okay, so we've got higher time frame biprimary. So we've got one piece of the puzzle. High time frame mitigation complete. Okay. Now, I can already see the second one. This is the second one. The second one is actually inside this one. So from, you see how this was all stacked. The lower time frame mitigation does not have to be outside of this. It doesn't have to initiate outside of the box, then come back in and create it, something like this. It does not have to be like that. It can also be this right here, that where this created this range right here went over the top of the liquidity here, this bit of liquidity. It was this range that did the damage, and then they initiated away on themselves, breaking structure up here, right? So let's just wait and watch. There it's the structural break. Yeah. Okay, so higher time frame mitigation complete, lower time frame mitigation complete. That was from over here. Okay, so let's just pull price out. Won't take a sec. So here's that breaker range. And so as soon as a breaker occurs, a transitional order block on a higher time frame, we can start looking to see what you mitigate, what you do. Okay, so now I'm just going to pause it. The ideal thing for us to have happen right now would be for them to create the setup range. Okay, the liquidity state into a liquidity state into another liquidity state, right? A sell primary into a buy primary. That would be the most ideal thing. they don't always do that. These setup ranges are initiation ranges. Okay, setup range means we're sending, we're going full tilt. It's like an event that they do. I think that just take all the liquidity in the market before they leave that area. I think that's really what it is on a most basic sort of thought process. So as soon as we've had that mitigation, right, high time frame and lower time frame mitigation, we need to be able to also say that this range that we've just created here needs to become a biprimary, right? And we can see from this chart, the 1 hour, that it absolutely is, because this range here, the buy range, range initiation break of structure, from the higher time frame standpoint, that put money down here, right? And so this range just took the money, did the high time frame mitigation, did the lower time frame mitigation, and then took off. And the way in which you know when they're about to take off and if that's a valid mitigation is they'll take out the most recent range and breaker range, and that is our sort of entry point, so to speak. That's our this is our time to shine, right? So one of my entry methods was just place it right here. Another entry method was just place it right here at the bottom. Another method is go 50% and have your stop below the low. There's lots of ways in which you can sort of start to enter the market. And then targets, it's, that's up to you. That's going to be the fun part, figuring out the targets, like 10R, 5R. How much R do you need? What are you, what are your goals really? Break of structure, everyone's different. And so in this instance, you wouldn't want more than 6.5R if you took this trade right here from this location, because we got a wick right at the top. They did this on purpose. Trust me, they did this on purpose. They did not close with a full body up here on purpose. It was the wick that did the damage because they had intention of pulling back. So that's what this is all about, right? I'm trying to piece this together for you guys so you can understand when we have these sort of big old ranges and we initiate higher prices, we're always going to be, every time we come back, have a pullback, we're always going to be looking for higher time frame mitigation and lower time frame mitigation in the same place. As I draw, what I mean by that is as I draw my arrow, it needs to tick both boxes, higher time frame and lower time frame. Okay, and if it does that, then it's a pretty decent mitigation and should be considered or could become a potential for high prices in this instance. So I know I've dirtied up my chart a little bit here. It's looking pretty messy. Why not? Let's just get rid of all of that. It's no benefit to us here. It's just scrappy on the charts. There we go. Okay, so let's ray this out. Let's play this out. So I know this video is going on a little bit too long, and I've kind of taught you spoke about what I wanted to speak about there. So now I'm going to sort of briefly sort of touch upon these, and we'll do it probably on what, 4 hour, 2 hour chart. What's the best? Maybe a 1 hour. So like I said, as we have these pullbacks, they should create primary ranges. Every pullback should become a primary range. And the primary range has to end with a higher time frame and a lower time frame. Well, here's your higher time frame. Here's your lower time frame. Okay? If it ends in those and then takes out the other range, the last known range, then you can start looking for entries. Right, so this would actually be the breaker in this instance. And they always like to mitigate the breaker. I need to mention that. The breaker always gets a touch, eventually. Sometimes it doesn't get it straight away, but it'll always get a touch. There's always an opportunity for you to get back into the marketplace. And hopefully it's at a lower time frame point of interest. So for example, here's our break in structure. So once we break structure, we're then looking for, look at this range. This was the last known buy range. Let's go back right to here, this point here. right? Range, initiation, break of structure, and then what happens? Almost immediately after, boop, this has now become transitional order block because prices have pulled through it. Prices have pulled through the range. It's no longer valid, right? It couldn't hold. So I color those in purple. And so what does that mean? Well, it means that this is the area we're expecting a mitigation from, number one. Number two, right, this big purple area is where we're expecting the mitigation to happen. We don't know if it's going to happen here. We don't know if it's going to come below the box. We don't know anything at this point. We just know to expect that. And so we've got this breaker here as well, which is telling us we can now start to look for mitigations. And so we've got this. I'm going to conclude that this is the higher time frame by primary in this instance, right? It's now this one's now the higher time frame instead of this because we haven't actually closed out of this, right? We're forming this. We haven't closed out of this bigger one. So this is theoretical. So it should be really shaded different color maybe so that we don't get too confused. Let's take it down to, yeah, 16%. Just while we're talking. And so what would we be looking for? Well, we're expecting a mitigation. We know that the mitigation we know it will happen in here because this is the primary range that we spotted, right? So we know that there's our higher time frame done. So where's our lower time frame? So now let's drop down to our 15 minutes. We know that as well. Oh, I can see it right now. You can see this big wick. Boop, right there. I mean, it's a potential for one at least. So even on a lower time frame, 5 minutes. Oh, we can't get to 5 minutes. Damn, 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 damn. Can we get to 10? Okay, we can get to 10 minutes. So you see range initiation. Was there some sort of structural break? Or here's one that definitely activates that one. Was there something that activated this? Yeah, right there. So these two are both active ranges, which means you can put liquidity. I know I'm not drawing the ranges on. I mean, if you want me to, I can, but it's silly, really. And then this is the primary range that came over the top. And so now I can see that we have, I've got another primary range here. See how this candle right here broke the low here? So that became a range. Here's the breaking structure. And so did anything come over the top of it? Yes, it did, right here. And so these connect as well. So we know that the mitigation is either going to occur in here or it's going to occur here. But either way, it should tap one of these. If it doesn't, that's okay. Let's see. See what happens. I'm pretty sure we get a secondary touch, wasn't it? I think we observed it on a higher time frame when we're on the higher time frame. Interesting. So there's our second touch. So let's see what happened here because we were expecting the obvious primary ranges to get slapped, get mitigated. But let's see what happened here. And I'm not certain we can go lower. We can't, right? So let's see if we can see it though. Yeah, I can't see it. There's definitely a structural break that occurred here, right? So this could have been a range that went over the top and initiated. So maybe on a 5 minute, maybe on a 1 minute, we can see that this is a lower time frame range, but I cannot see I can't see it on this moment in time, this chart. So let's go to the 1 hour, just spread out and just see if there is another touch, something more obvious that we can see, or if that was actually it. So that first touch may have been the mitigation. Second touch may be the mitigation. We're going to see, do we continue price up over where my mouse is? If we do, then that was the mitigation. Yep. So we've broken up. So now this is absolutely the buy primary. This was the high time frame, and there was a lower time frame in here. And I wish I could show you guys. Like, I can absolutely guarantee it's there. And they'll do this kind of stuff, right? Absolutely, all the freaking time, where they'll leave things that you think are obvious that they should come back to, and they do it for a big reason. They don't want you to get in the market. You know, they're not dummies. They know that we know how they do everything. They have to continually design new patterns, I guess you could call it, new patterns to sort of trick and confuse. And so this is part of that. So these buy primaries right here that are sat sort of doing nothing, waiting for mitigation, are literally just that, waiting for mitigation. But these will be a future event. These will be futuristic events. So we can look at that too. If we actually go out to a 12-hour, why not take a little look and see if we get. Now that was an unexpected pullback, wasn't it? Right into the heart again, into that same sort of an area. I kind of like to see just what happens when price gets back to these levels. Maybe price hasn't even come back to these levels, actually. Let's go on this higher time frame. Look. Yeah. So we actually haven't had the remitigation, but as we do eventually get back to these levels, these are going to be sort of reaction points, right? They will absolutely react in and out of these. How much of a reaction, we'll see, but because they're unmitigated, they will get their reaction. Unmitigated by primary, absolutely going to get a reaction. How big, you just don't know. So that's really what I want to talk about today is when we have mitigations, anytime we have a pullback, there's a higher time frame and a lower time frame primary range that gets mitigated. I just talked about it a lot here. And so as we're sort of, looking at what's going on with this, the S&P 500, the mini here, the micro E-mini, what we can conclude then is that every time we do take out a breaker range, a transitional order block, that gives us an opportunity to look for higher time frame and lower time frame mitigations. And so getting closer now to sort of current price action, what happened here? We had exactly what I've been talking about. High time frame and lower time frame mitigation. Let's see. Let's see it. So there's one. So there's a high time frame one, and I can already see you've got something in here. Let's go down to 5 minute now, see if it will let me do that. And there you go. I've actually already drawn it on there. So here's that higher time frame, and here's that lower time frame primary range. Okay, so that's really how this all works, how the markets move. Just keep looking for a higher time frame and a lower time frame. You can make this as small as you want. I'm on a 5 minute chart right now. We started on a weekly and monthly. You can go down, 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 down. Just keep your higher time frames in mind because they are the most important driver of price into certain direction. Okay, but that's why I started way back here looking at this weekly because now I know what to be looking for, and every time I see a break of structure, a breaker block, like a transitional, then I can start to look for, hey, what are we forming here? We're probably forming this, and so can trade accordingly. That is it for this video. I know it was a bit messy. Ask me your questions. Did I not explain something very well? This is literally gold what I'm giving you. I absolutely have studied the markets now for years and years and years, and this is what I have concluded to be the absolute best information possible, sifted through thousands and thousands of hours of other bullshit out there. This is stuff that works, at least works for me. Come to your own conclusions, but use my knowledge to help maybe form ideas and come up with new stuff as well. So that's it from this one, you guys. Nothing more to be said. Love, love, aloha. Hope everyone's smashing it, crushing it, enjoying life, and having an amazing experience. Peace out. I'll catch you on the next one. Cheers.